This is not just another day in the financial world. As the global economy pulses with uncertainty, investors are witnessing seismic shifts across major markets. The Dow Jones opened with a jolt, plunging over 500 points within the first hour of trading, triggered by escalating fears of an impending debt crisis in China. This came after reports indicated a significant default from one of China's largest real estate developers, prompting ripple effects through Asian and European markets. With traders scrambling to reassess risk positions, volatility has returned in full force. Cryptocurrency markets weren't spared. Bitcoin dropped nearly 7% in a matter of hours, falling below the crucial $60,000 psychological barrier. The sell-off intensified following reports of increased regulatory scrutiny in the United States and South Korea, with both nations signaling harsher controls on crypto exchanges. Ethereum, Solana, and other altcoins mirrored Bitcoin's movement, with liquidations exceeding $1.4 billion across major platforms like Binance and OKX. Fear is gripping the market, and the digital gold rush is rapidly transforming into a cautious retreat. In the commodities sector, gold surged by over 2% as investors sought safe haven assets amidst the growing market turbulence. Oil prices, however, took a downturn as the IEA slashed global demand forecasts for Q3 and Q4, citing lower than expected industrial output from both China and Germany. Brent crude fell to $76 a barrel, down from $81 earlier this week, while WTI dropped beneath $72. Energy traders are now revisiting bearish strategies, especially with hurricane season expected to impact refinery operations along the Gulf Coast. U.S. Treasury yields also experienced a significant spike, with the 10-year note climbing above 4.25% for the first time in 3 months. This jump comes in response to a hotter-than-expected CPI print, which showed core inflation rising at an annualized rate of 4.1%. The data shattered hopes for near-term rate cuts from the Federal Reserve, prompting a wave of repositioning among fixed-income investors. As yields rise, so do borrowing costs, further compounding the challenges for growth-focused tech firms. Speaking of tech, shares of NVIDIA, Apple, and Microsoft all took a hit today, with NVIDIA dropping nearly 4% after reports emerged that the company may face restrictions on AI chip exports to the Middle East. Apple also faced headwinds, with Chinese authorities reportedly cracking down on the use of foreign-branded devices within state-affiliated firms. Meanwhile, Microsoft is facing a potential antitrust investigation from the European Commission related to its integration of AI services into core enterprise products. Across Europe, markets mirrored the U.S. turmoil. The FTSE 100 dropped 1.7%, while Germany's DAX fell 2.3% amid concerns about stagnating industrial growth. A surprise contraction in French manufacturing data added further pressure. Investors are now bracing for a possible ECB pause as policymakers weigh inflation data against the risk of pushing the Eurozone into recession. European bond yields rose in tandem with U.S. Treasuries, with Italy and Spain seeing the sharpest increases. In Asia, the Hang Seng Index dropped by over 3% as Chinese property developer Everrise missed interest payments on 2 major bonds. The default reignited fears of contagion within the region's banking sector. Japanese markets also saw losses, with the Nikkei shedding 1.5% after a disappointing earnings report from Toyota. South Korean chipmaker SK Hynix tumbled nearly 6% on news that U.S. export controls might expand to include more semiconductor equipment. The currency markets responded dramatically to these developments. The U.S. dollar index climbed sharply, hitting 104.6, as traders poured into greenback-backed assets. The Japanese yen weakened to its lowest level since November 2022, prompting speculation that the Bank of Japan might intervene to stem the decline. The euro dipped below or 8, pressured by weak industrial output data and a growing divergence between U.S. and European interest rate outlooks. Meanwhile, consumer sentiment in the U.S. has taken a sharp downturn, according to the latest University of Michigan survey. The index fell to 64.2, down from 71.6 last month, marking the steepest monthly decline since the onset of the COVID-19 pandemic. Analysts point to rising fuel prices, mortgage costs, and fears over job security as primary contributors to the drop. Retailers like Walmart and Target are already bracing for weaker Q3 sales. On the corporate earnings front, Bank of America posted better-than-expected results, with net interest income up 7% year-over-year. However, the bank also revealed a sharp increase in loan loss provisions, hinting at rising credit risk among consumer borrowers. JP Morgan and Citigroup report later this week, with analysts closely watching their exposure to commercial real estate and leveraged loans. Geopolitical tensions are adding to the uncertainty. The Strait of Hormuz saw another maritime incident, with a cargo ship reportedly attacked by Iranian-backed militants. This has sparked renewed fears over oil supply disruptions, even as OPEC Plus maintains its current output stance. The White House issued a statement condemning the incident and warned of potential retaliatory measures. In Latin America, Argentina's central bank shocked markets by implementing a surprise interest rate hike of 500 basis points in an attempt to stabilize the plummeting peso. Inflation in Argentina now exceeds 140% annually, creating immense challenges for consumers and businesses alike. The IMF is reportedly in advanced discussions to renegotiate loan terms with the Argentine government. Venture capital funding continues to shrink, with Q2 2025 figures showing a 23% year-over-year decline globally. Startups in fintech and biotech have been hit the hardest, with investors demanding clearer paths to profitability. In Silicon Valley, layoffs continue across mid-sized tech firms as they grapple with funding shortages and margin pressures. The real estate sector in the US is showing signs of cooling further. New housing starts declined by 5.1% in June, while existing home sales fell to their lowest level since April 2020. Mortgage rates now hover near 7.2%, placing homeownership out of reach for many first-time buyers. Home builders are responding with incentives and aggressive price reductions. Social media stocks are also under pressure. Meta lost 3.6% today after a whistleblower alleged that internal moderation policies were ignored in favor of engagement metrics. It's not all we being sued by several advertisers who allege fraud in ad impressions. The digital advertising space is becoming increasingly fragmented as brands seek alternative platforms and AI-driven targeting methods. AI remains a bright spot in the broader tech landscape, with companies like OpenAI, Anthropic, and Cohere attracting fresh capital despite the market downturn. However, even these darlings are facing tougher questions about monetization, data privacy, and regulatory compliance. The global AI race is evolving into a battle not just of algorithms, but of ethics and governance. Investors are shifting their strategies rapidly. Hedge funds are rebalancing toward energy and commodities, while retail investors are increasingly flocking to cash and short-term treasuries. The VIX, Wall Street's fear index, surged to 22.7, its highest level since March. It's clear the market is bracing for continued volatility. In Washington, discussions are intensifying around a potential government shutdown as budget negotiations stall. A last-minute deal now seems unlikely, and agencies are preparing contingency plans. The potential shutdown could delay key economic reports, disrupt federal employee pay, and dent investor confidence further. As the day closes, one thing is certain: complacency is not an option. With so many variables in motion, rate hikes, geopolitical threats, energy instability, and shifting consumer behavior, every decision counts. Whether you're a day trader, a long-term investor, or simply trying to protect your assets, now is the time to stay informed, stay agile, and be ready to pivot. If you found this breakdown helpful and want to stay ahead of the financial curve, don't forget to subscribe, like, and turn on notifications. This channel brings you daily deep dives into what's shaping the markets and your money. Your next opportunity or risk could be just one headline away. Stay sharp.